Hey there, friends and followers. This week's video is all about PMI, or personal mortgage insurance. We'll find out exactly what it is and how it can affect your new home purchase. Stay tuned. So yes, as always, welcome back. Now, one of the most exciting times in one's life is finally being able to call themselves a homeowner. Buying a home can sometimes be no easy feat, and understanding the process and the costs associated with making that purchase can be even more daunting. One particular item that I find most people don't understand or are even aware of is private mortgage insurance. Now, like it or not, typically mortgage insurance is going to be involved in your next home purchase. So, what is mortgage insurance? Well, private mortgage insurance, or PMI for short, is a type of insurance policy that protects mortgage lenders in case borrowers default on their loan. You're usually required to pay PMI if you make a down payment that's smaller than 20%. With some mortgage products, PMI is a temporary requirement, but with others it will last the lifetime of the loan. So, why is this required with my purchase? Well, typically the rule of thumb is this. If a borrower defaults on their home loan, it's assumed that the lender or the financial institution will be set back roughly 20% of that home's purchase price. The expensive PMI covers that extra loss margin for the lender. If you were ever to default on your home loan, the lender will receive a lump sum from the mortgage insurer to cover their losses. If you put down 20% as a down payment, that makes up for the lender's potential loss if your loan defaults and goes into foreclosure. If you put down less than 20%, the lender is likely to lose money if that loan goes bad. So after sorting out expenses of taxes, home insurance, and principal and interest, some would say that PMA sounds like just another frivolous expense. But that's where not understanding the importance of it comes into play. In fact, PMI can actually jumpstart you into home ownership. Think of it like this. Without mortgage insurance, many people would have to wait to save up that 20% down payment before buying a house. Those are years that they could have spent investing in their home and building equity rather than paying out to a landlord each month. Plus, the benefit being that most borrowers can eventually cancel their PMI, so you're not stuck with that added fee forever. It's a temporary cost that can have great reward. So, how much does mortgage insurance cost and how is it calculated? Well, PMI costs can vary by product that you use in which to make a purchase, but generally speaking, the cost is 0.5 and 1.5% of the loan amount per year. So even for the exact same loan size, mortgage insurance costs could be very different depending on whether you obtained a conventional mortgage, FHA, VA, or USDA mortgage in which to buy a home. The cost is broken up into monthly installments and added to your monthly mortgage payment. Now, please note that some mortgage types will also charge a higher upfront mortgage insurance fee. This is paid once when the loan closes and can typically be rolled into the loan balance so that you do not have to incur that added cost at closing. The cost of the mortgage insurance is generally affected most by a borrower's credit score and their loan-to-value ratio. And since annual mortgage insurance is recalculated each year, your PMI costs will go down every year as you pay down your loan amount. So when can I get rid of PMI? Well, if you have a non-government conventional mortgage loan, PMI will automatically cancel when your loan-to-value ratio falls to 78% of your original balance, or you also have the option of canceling PMI once your LTV ratio drops to 80%. Mortgage insurance works differently for government-backed loans such as USDA and FHA mortgages. With FHA, if you are able to put 10% or more down with your purchase, the mortgage insurance should expire after about 10 or 11 years. Another option, if you didn't put that amount down during your purchase, is once you reach 20% equity, you can refinance out of the FHA loan type into a conventional loan and move forward without that cost any longer. You can follow a similar process if you bought a home with USDA financing. So in conclusion, sure, the thought of having this added monthly expense factored in can be a slight burden, and in some cases actually dissuades individuals from pursuing home ownership altogether. However, with the inclusion of PMI, you can work towards getting into a home sooner and start building your equity. Housing expenses are going to be required whether you rent or own regardless, but when you own, you'll be depositing a small chunk towards your future wealth each month versus renting where you won't necessarily see a return on that investment. Well, there you have it. That has been a 101 on PMI, or private mortgage insurance. Hopefully you guys were able to take a thing or two away from this video. As always, if you'd like any further elaboration or any questions on this matter, drop a comment below, shoot me off a message. As always, slide over to the page, give it a like and subscribe to stay up to date when great videos like this are released. As always, thanks for tuning in, checking them out, and we'll catch you guys on the next.